for tomorrow. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Saying up 1%. The Taiwanese index also up 0.4%.
The 20-day for the Nifty is moved up to 25,844.
Outside India, we are holding a market share of almost 9% in the middleweight, but still we see there's a huge scope for us to create one more success story, what we have created in India.
Market open coming up on your screens is up about 0.2% in the Nifty, 0.2 on the Nifty Bank.
I don't think you have globally diversified just because you have bought an NASDAQ or S&P.
We open in the green, but we are off the highs of the day. So it's a 40-point uptick as we speak.
Renewable sector is growing. In fact, I think we are really beyond plan when we look at the policy numbers. Nominal GDP, that's growing at only 8% versus 8.3 year ago.
Now, we are still in the green, but considerably off the highs of the day, almost a 60-point cut from there.
Okay, well, that is the day so far, and markets have been sluggish, difficult, can use all kinds of adjectives. 35 points down on the Nifty, but the broader market is looking much tougher. This is Closing Bell. We're coming to you live from the CNBC-TV18 Motilal Oswal studios. I am Prashant. With me, my colleagues Nigel and Rima, as we've been telling you from the morning, it's back from Japan.
Yes.
Arigato. Arigato.
Still waiting for that
gozaimasu.
mail though, Please come for...
I think I'm the good luck charm for IT. IT is doing well today. The Nifty IT index is supporting, and banks too have picked up now.
Yeah, that's right. But the Nifty, not a good luck charm. I mean, at the low point of the day, Rima. But, we keep debating about this all-time highs and not. I mean, portfolios are not feeling anything like that. The breadth of the market is terrible. I think there is some big liquidation that's taking place. Last two sessions, maybe a few more sessions, and maybe, just maybe, if it's just liquidation of positions and, maybe people clearing out before the end of the year, as Prashant made that point about PNL, you want to protect the PNL towards the end of the year. And maybe we could expect an equally sharp bounce as well on some of these names. But otherwise, the broader markets are in immense pain all through the trading session.
But we're already talking about year-end portfolio.
Yes, 750 hours. After that, I'm not in the studio.
Well, we've got a month to go before I thought.
72,
Yeah.
3 weeks, right?
Yeah, 22, 23 days, right? Trading working days. Trading.
Closer than that is the monthly expiry this week.
Yeah. No, but it's the broader market, right, which is looking pretty bad actually.
Yeah. Painful.
And it's kind of there you go. That's the advanced decline, and it's only gone one way. So almost 2,200 down and about 750 up. That's the overall picture. And what is up small. Except maybe the IT services, and we'll talk more about that one as well. Let me just quickly run you through what's lined up here on Closing Bell over the next 1 hour or so. So we've got, the markets, of course, in focus. What next? The question remains. 26,000 is the level where we're at, closer to 26 than 26,100 now. And a lot of mid caps and small caps are under selling pressure. IT, Motilal has, I think, upgraded their view. JP Morgan likes the IT space as well. So more on this. The new labor code is now effective, and there are lots of changes afoot for many sectors like IT services and, of course, many other areas. And I think we'll tell you some of the impact, but I reckon not all of it, as this will be understood over the next few trading sessions, next few days. MCX, you rarely hear the new CEO, the new MD, Praveena Rai, but she spoke with us, and we'll play out some sound bites in terms of what the ambitions really are for the dominant commodity exchange, excerpts from that chat coming up a little after 3 o'clock today. How should you position yourself is the question. Mitesh is with us to answer that. Mitesh, good afternoon. Good to have you with us here. Where are you looking for trades, and what are you seeing out there?
Good afternoon, Prashant. So, in the morning I was saying this, that if we don't get past the earlier highs, the previous all-time highs, then I think there could be more of a pullback, and the Nifty would give you a better entry point. I think that process is going on, and I would still suspect that 25,800, 850 is the area, where I think the Nifty might take support, and then we might see a reversal or an attempt to move on the upside. So till then, I think on the index, wait it out. On the stock side also, we've kind of reduced long exposure, suggested people to explore some shorting opportunities. And I have two sell calls right now. IRCTC is a sell with a stop at 694. Look for targets of 660. And Bajaj Finance It was a sell earlier as well, but the stock was sideways. Today is breaking that sideways range on the downside. So sell with a stop at 1011 for targets of 960.
Okay, all right. Got that. Now, Mitesh, we'll come back to you for more a little later. But let's get to the first story that we want to address right now. As some newspapers are saying, that the winter session of Parliament is expected to be a substantial one, with many bills which are likely to be passed, especially in the economic sphere. One area is going to be insurance, the Insurance Amendment Bill. It's listed as a bill which will be taken up. But what is within the bill is essentially what we want to talk about. There are two things. There are things like 100% FDI, composite license, and those things are understood that they will be taken up. But there were two specific issues. One, of course, was open architecture for individual agents, which is important for LIC, which we reported on. Yash got you that story a couple of hours back. The second one is now flashing at the bottom of the screen, which is with regards to the government likely in the bill to propose permitting merger between insurance and non-insurance companies. Yash is here. Yash, let's start with the second one first, if we can.
Well, that's correct, Prashant. First of all, let me just tell you, it was 4 years ago when the amendments to the Insurance Act were first introduced. It's taken about 4 years, a lot of back and forth, a lot of committees, a lot of consultation papers. Finally, the winter session of the Parliament, the upcoming session, is expected to be to table the Insurance Amendment Bill, and that has been made a list of business for the winter session of the Parliament. As you said, the second one first, a big positive expected as far as Max Financial Services is concerned, because what we're picking up from our sources is that the government is likely to, of course, table the Insurance Amendment Bill, and under that, it is expected to allow mergers between insurance companies and non-insurance companies. You know, Max Financial Services, Axis Max Life have been talking about, wanting to do this reverse merger between Axis Max Life and Max Financial Services for simplification of the corporate structure and removal of that holding company discount from Max Financial Services. And the government this time around in the winter session, according to our sources, may very well allow that merger between insurance company and non-insurance company. As I said, this will pave the way for the merger between Axis Max Life into Max Financial Services, simplify the corporate structure between the entities, and removing the holdco discount as far as Max Financial Services is concerned, which owns about 80% stake when it comes to Axis Max Life. Currently, the Section 35 of Insurance Act restricts mergers between insurance companies and non-insurance companies. But once the government allows this particular merger, which is expected to happen in the winter session, that Section 35 would be removed and the mergers between insurance companies and non-insurance companies would be allowed. What we've also been given to understand, and it seems that, mergers and acquisitions would not require IRDAI approval, as IRDAI's role would be of framing regulations and granting registration to new insurance companies from the point of view of better corporate governance.
Okay, all right. Yash, thanks very much for that. This is, of course, important because we'll need to, for Max Finance especially, this is an important one. Yash, very, very quickly, in 30 seconds, the open architecture bit which we've already reported on, because LIC is the one which is affected the most, right? I mean, 90% of the premium they collect is via agents. I mean, that's the channel. So take us through it.
Well, as you said, two important numbers. LIC collects more than 90% of its new business premium from agents, and SBI Life collects 28% of its new business premium from agents. And that agency network for both these companies could come under threat if open architecture is indeed allowed, which we are given to understand from our sources that the government, as a part of the same Insurance Amendment Bill, is expected to allow open architecture. What does open architecture for individual agents mean? Essentially, currently, these agents can only tie up with one life, one general and one health insurance companies. But once open architecture gets allowed, then individual agents will be allowed to tie up with multiple life, multiple health and multiple general insurance companies. What happens in that case is that if any other insurance company is paying slightly higher commission to an agent as against its primary insurer, then the agent, in search of that better commission, could switch to that other insurance company. And in that case, the primary insurer might have to pay higher commission to match up with the second insurer to retain the agent, or maybe lose out on that business. Why is it only a big negative for LIC and SBI Life? Because large part of their businesses do come from the agents, and hence the maximum impact of this on the negative side goes to them as well.
Okay, all right. Yash, thank you very much for that. We'll get Mitesh is with us, and we'll ask him for his views on Max Financial, LIC and SBI Life in just a bit. Mitesh, you want to weigh in if these three, anything looks interesting here?
Yeah, I actually, have been looking at the chart of LIC, and because that's where, we've seen a range of about 925 to roughly about 880, 875. And now, there are early signs that the range may break on the downside. So that's one worry. SBI Life, I haven't looked at it in detail, but the stock after the run-up, is down today, and this could purely be because of the fact that the stock is overbought and just giving a pullback to the averages. So between all the three, I think the one which I'm really looking at, which could give some kind of a negative movement is LIC if it starts breaking below 880.
Okay, all right. Breakdown perhaps, right, in LIC out of the three. Mitesh, thanks very much for that. One more exclusive. Now, sources suggest that a large transaction may be in the offing in the Indian QSR space. Vivek is here with details. Vivek, take it away.
Well, that's right. This is one particular deal that was most likely going to happen last year, but what actually transpired was that multiple PAs who were interested in buying out Everstone Capital's stake in Restaurants Brand Asia pulled out at the last minute. But what we are understanding from our sources is that Everstone Capital, which is the private equity which manages Restaurants Brand Asia, which runs both Popeyes as well as the more famous Burger King, they have reinitiated efforts to go ahead and exit their stake in Restaurant Brand Asia. They are now in talks with multiple interested parties. We understand that amongst the interested parties are a clutch of private equity investors, and along with that, a large family office of a listed company in India has also evinced interest. They appear to have some amount of interest as far as the QSR space is concerned. So this will be a logical extension for that particular family office. Now, what we are understanding is that the negotiations are at an advanced stage. The bids received are at a premium to the current prevailing market price. And very interestingly, now according to SEBI's rules, there will be an open offer that is triggered, despite the fact that Everstone Capital just holds close to 11.2% stake in the company. This is on account of the fact that there will be a change as far as the control of management of Restaurant Brand Asia is concerned. Now, we reached out both to Everstone Capital. They did not give any comments, and we are still awaiting a comment from the management of Restaurant Brand Asia, but this will be an interesting development. Remember, earlier efforts were there, but we understand that this time around, talks are at an advanced stage, and before the end of the year, we could hear some development as far as RBA is concerned.
Thank you very much for that. Gurmeet Chadha is now joining in from Complete Circle. Gurmeet, thank you very much for joining in. You want to come in on the story that Vivek was talking about?
No, so Rima, we don't have this portfolio, neither do we track. I've been hearing things around it on the show, so we don't track this one.
Gurmeet, hi, afternoon. The insurance story that Yash was talking about, any thoughts?
Yeah, so long awaited, Prashant, and I think it's much needed, especially individual guys being allowed to source multiple. I think what it could impact is larger guys like bank-backed life insurance companies who are heavily dependent on banca as a larger mix. From the premium they source, especially the new business premium, and that's where they get more surety, both in terms of fresh as well as renewal. So, but overall pretty positive. One name which we like is the Max Life, which will become Axis as ownership changes. I think they're registering good growth, both in terms of value as well as new policy source. And with the new management in place, that's something we are tracking very closely. Other than that, we have ICICI Lombard in the portfolio. Incrementally, the total ratio is now coming around 100. Below 100 is where you make more money from underwriting profit and not just investment income. So that's something these both names is what we have in our investment universe.
Okay, all right. Hi, Gurmeet. Good to see you on the show, Gurmeet. My colleague Parikshit, he went ahead and interviewed Royal Enfield, a rare interview, interesting one out there. 125 years is what they've completed. From the two-wheeler pack, what do you like? I think personally as well, you've owned a Royal Enfield, if I'm not mistaken. But what do you like in terms of stock preference?
So, proud owner of Royal Enfield, Nigel, like you, but portfolio, we have TVS in the portfolio. I think it's doing well on across front, domestic numbers, gaining market share in the premium segment. The EV version doing very, very well. In fact, they're now the leading player there. Exports picking up and very, very good capital allocation. The stock is consolidated after a very good run up, but continues to do well. Slightly at a premium, valuation premium compared to, let's say, a Hero MotoCorp or even, let's say, Bajaj Auto. But, market in this kind of market, it's rewarding growth. So that is something we like in the portfolio. And we continue to add more auto ancillaries in the portfolio. We're tracking, Sandhar Technologies. We are tracking Raj Ratan Global, which is into bead wires into tires. Obviously, I spoke about KPIT Tech. I think with IT rebounding and auto rebounding and globally auto looking a little better, I think that's something which could be important. So we continue to be bullish on the entire space. We would probably be at about 14-15% weightage on auto and auto ancillaries.
Okay, all right. Gurmeet, so you're riding the Royal Enfield, but in terms of stock preference, TVS Motors is something that you like. Just a half hour back, God, I wrote a piece about how I bought my first Royal Enfield, on my LinkedIn profile as well. But since you spoke about tech, I think that's a good time to go across to Rima. Rima, you're back. Good luck, charm for the tech space. And Motilal Oswal as well believes that things are turning around out there.
They do. So they have upgraded the Indian tech sector from an underweight to a mild overweight. And there are three key reasons for that. One, the recent underperformance. The Nifty IT index has underperformed not just this year, but over the last 3 years. Secondly, even on the global hyperscalers front, now increasingly they believe that we're seeing diminishing marginal utility from infrastructure build out, and the attention will shift from building to perhaps more maintenance and application, which is where the Indian IT companies fit in. And they also, support the valuation argument by saying that in the Nifty 50, the profit pool of IT companies has remained unchanged at 15% for 4 years. But the weightage of IT stocks in the index has been coming down, and it now stands at a decade low of 10%. So all that makes them confident that perhaps the cycle is now turning, and they have upgraded it to a mild overweight. Infosys is supposed to be one of their top winners. They've upgraded it to a buy. They believe the current valuations are fairly attractive. But even outside of that, they've upgraded Emphasis to a buy. Wipro has become a neutral. Zensar, they've upgraded it to a buy. And in the mid-cap space, Hexaware and Coforge are some of the other IT stocks that they like. And generally on this labor pool, the labor laws and the code, it's not going to impact the Indian IT companies too much. So that is not a headwind, though the industry is one of the largest employers of the formalized workforce, and the wage bill is, about 70-80% of the overall expenses. But even then, I spoke to a few analysts, and they don't expect the labor code to have any material impact on any of these IT companies. Gurmeet, do you think the cycle has turned from IT, from an underweight? Maybe you can go overweight?
As a contrarian bet, as I spoke earlier, we have HCL Tech in large cap in the portfolio. We have KPIT Technology, which I mentioned just a while back. And I think we will tactically look at adding few more names in case, there is a closure to the US trade deal, because I think it's very underowned. And as you rightly mentioned in the brokerage note, completely out of favor. And valuations have turned reasonable. I would not say that they're very cheap, because you still have large cap IT at about 90-20 times. But as I said, it could be a good trade in case things ease off. And, at later stage when the AI adoption picks up, I personally think the mid-cap, small cap ones are more agile in terms of making that pivot versus large cap names. So we like Persistent. We're tracking Coforge. There is Newgen Software, which is on our radar. So I would prefer to do it through the small and mid cap IT. In large cap, as I said, we have HCL Tech, because that's more diversified. It's not just IT services. There is the software business, which is now more than 25% margin, which they acquired, and now it's really turning around. And obviously the ERD business as well.
All right, Gurmeet, what about from the NBFC space? We had Chola this morning, and management sounded reasonably optimistic. They're talking about 20% growth. They're sticking to that 20 to 22%, which is scale back a little bit. ROAs, they're looking at around 2.2% to around 2.4% odd. They're saying asset quality is pretty okay, and the credit cost will be ballpark 1.5% or thereabouts. But, one of the stocks on the NBFC, if I'm trying to look at stocks that have gained big time from the financiers, Mahindra and Mahindra Financial Services stock is up 20% in the last 1 month or so in a market that's been jittery. We're talking about the mid-cap index not performing. This one, in fact, has woken up. What's your view on this name and from the NBFC space? Or what do you like?
Nigel, of late, there has been a liking to some of the smaller NBFCs, all smaller banks, wherever there is some signs of credit cost normalizing, ROA expanding, and turnaround happening. We've seen with a lot of equity infusion in tier 2 banks, whether it is RBL, Federal, etc., Yes Bank. We've seen that with some of the NBFCs like Samman Capital, etc. So I think there is interest there, and I think valuation comfort has been there, and they've come off from after a rough cycle in 2019 and COVID when the entire IL&FS episode happened. So I think L&T Finance and M&M actually have shown that kind of a turnaround. I think even in some of these small finance banks, some of the, something like a Credit Access Grameen, etc., there might also be some more juice left if the market believes that the stress has, eased out. So we have a combination of it. We have ICICI, HDFC in amongst the top banks. We have Federal and RBL in tier 2 banks. And amongst NBFCs, we have a gold NBFC play, which is Muthoot. And we have Chola and Poonawalla. So we are looking at, as I said, across the spectrum. And this again, along with auto. So with financials and auto, continue to be the two most overweight positions for us in the portfolio.
Okay, Gurmeet, thanks a lot for that. And I recall you commenting on NSDL, I think, so that, in the unlisted market, it was trading at very, very elevated levels. Listed, the IPO price was much lower than what it was in the unlisted market. So that was a good word of caution out there. I think it was around 1,100 rupees. The IPO came at far lower levels. And after the run we have seen, it's back at around 1,100 rupees as well. So kudos on that call on NSDL when it was in the unlisted market. Thanks a lot, Gurmeet, for joining in. Well, time to slip into a short break. On the other side, we have Ankit Jain from Mirai Asset Mutual Fund, who will be joining in.
Welcome back. Let's put the spotlight now on the top movers in the market. Harmis is now joining in. Harmis.
Some interesting names that have come up in today's session. There's a sharp spike seen in Muthoot Microfinance, not just in the stock price after 1 o'clock, but in terms of volume activity as well, more so. The stock is up 6%. It's the biggest single day gain since April. The volumes are the highest in just over a month, but this is the third instance in the last 7 sessions where more than 5 lakh shares have been traded in a single day. Now, after around about 1 o'clock, there was a sharp spike in volumes. We have already had close to 18 lakh shares that have been traded on Muthoot Microfinance today. The 20-day average is just over a lakh. And this one is turning out to be the third straight month of gains for the stock. VLS Finance, we spoke about it all through the morning as well. So 7th out of the last 8 sessions now that the stock is gained. It has announced a 100 crore rupee share buyback, which is around about a quarter of its free float market cap. We had 11 lakh shares of the company that have been traded now, well above the 9 odd lakh shares that traded last Monday when the earlier intimation of the buyback had come. The 20-day average is just around 98,000 shares, trading above all key moving averages. And despite this month turning out to be the best since June of 2021, the stock is still down 8% on a year-to-date basis. ITI is the other mover within the broader markets today, 12% higher. It snapped a 6-day losing streak in today's session. The volumes are the highest in nearly 2 months. We have had over 2.5 crore shares that have been traded on ITI today. The 20-day average is just around 4.5 lakh shares. The stock trades above its 50-day moving average now convincingly at that. 50 DMA was around 321. that still falls into that less free float stock. So the government shareholding at 90%, another fund holding 8% as well, has been an underperformer this year, down 16% so far. And lastly, Oriental Hotels, that too has snapped a 4-day losing streak in today's session. The volumes here are the highest in nearly 3 months for the stock. We've had 8.5 lakh shares of Oriental Hotels that have been traded compared to the 20-day average of just around 1.5 lakh. So that's around 6x the 20-day average. But despite this kind of up move today, the stock still remains below its key moving averages and has given negative returns now for 5 months in a row, and hence the underperformance on a year-to-date basis as well. The stock down 29% so far this year, the first negative annual return that the stock may deliver in the last 5 years.
Okay, all right. Thanks very much, Harmas, for that interesting list as always. Ankit Jain is Senior Fund Manager at Mirae Asset Mutual Fund. Ankit, good afternoon. Good to have you with us here. Thanks for joining us. Prashant this side. It's a tough-looking screen, Ankit, across the board, right? I mean, lately, and especially if you're tracking things day to day, it has been, I mean, a few wins along the way. What do you suspect is happening, and is the market once again kind of trying to, discount out the possibility of this US-India deal? Who knows when it happens, but every now and then you get this euphoric thing that, well, it's very close, and then it doesn't happen, and then the market kind of sort of gets disappointed.
Yeah. Hi. No, Prashant, you are absolutely right. If you look into market, has seen a pretty good consolidation last 15 months. Last 15, 20 days also there has been a bit of a volatility. But it is last 15 months, if we try to look into it, is around concerns around growth slowdown, given tight liquidity environment, lower capex, and weak rural consumption. And also, if you look into the starting point of valuation, sometimes, let's say last year itself was very expensive, particularly in mid and small cap space, because it was trading at 40-50% premium to historical average, and that too on an optimistic earnings assumptions as such. But as things stand, if you look into, most of these factors are seeing an improvement. And a large amount of this is to do with significant policy impetus we have seen both around fiscal as well as monetary. Fiscal side, if you look into almost $35 billion relief has come by way of GST 2.0 and direct tax cut. And on the monetary side, also significant heavy lifting has been done, right? Almost 100 bips rate cut and $70-80 billion liquidity infusion through CRR cut and more. So this is clearly now reflecting in a brief cycle of earning downgrade, which we have seen over the last 4 to 5 quarters. This is coming to an end as per our view. And we do see earnings growth trajectory to actually improve from mid-single digit, which has been the trajectory last 3-4 quarters, to strong double digit going forward. And even if you look into, in this context, the quarter gone by, we saw a pretty decent earnings sort of a delivery. If you look into NSE 500 index, there has been almost 15% earnings growth. And even on the top line side, there has been a good jump from 6-9% reach to, to almost 8 to 9 odd %. And if you exclude financials and all, growth is even looking bit better. So I will say that whatever factors which has impacted market to consolidate last 15-18 months, I think we are seeing a pretty good progress on most of those counts. And even additional point being that valuations are now relatively more attractive. If you look into large cap, mid cap, whichever way, the valuations are now in the range of 10-15% premium versus historical average. So to that extent, I think we are quite constructive on the market at this point in time.
All right, okay.
On your point around, just to conclude on your point around this trade deal and all. I mean, difficult to pinpoint the timelines and all, but definitely India at this point in time confronts the highest effective US tariff rate at 34%. And while overall US goods export quantum is relatively low at around 1.5-2% of GDP, but this is also one of the fastest growing geography before the tariff coming into the picture. So to that extent, needs to be seen, but hopefully, let's see, maybe a couple of months down the line, we might hear something on this count. But clearly, as a result of this, we have seen FI outflow has been very, very high, and that is also partly one of the reason why actually markets are consolidating despite of incremental earnings downgrade coming down.
All right. Hi, Ankit. Good afternoon. Good to see you. And I agree on that point on the headline index. But if you tell someone, the fact of the matter is after many, many months, the Indian markets have outperformed the globe, which is a very, very encouraging sign. But if you tell someone about this, they'll be like, what are you talking about? Look at the month of November. The small cap index, I think, is down close to around 4%. And stocks are down 10, 15, 20% as well. So you would not be worried with the kind of selling that you see in the broader markets? Would you attribute it just to lightening of positions towards the end of the year? Maybe some large HNIs as well, taking some money off the table? Because the last few days has been a little bit worrying, I think, on that front. Your comment?
Yeah, Nigel, in the short term, there might always be this sort of a disconnect where actually small cap and mid cap underperforming meaningfully to that of large cap. But if I look into bit of a medium term, sort of a picture, mid cap and small cap is one space where earnings compounding potential remains far higher. And we have seen at any time frame on rolling basis, the earnings compounding can be pretty healthy at around mid-teens level, right? So to that extent, I will not be worried. Yes, near term there might be different factors at play. But having said that, even if you look into bit more medium term basis, some of this space has done exceedingly well, right? Despite of consistent earnings downgrade over last 15, 18 months, Indian market has held up reasonably well, I will say. Yes, try to compare globally, we might have underperformed, but there is right reason behind it of the starting valuations being high. But I will say at this point in time, most of the factors are looking in our favor, and we are quite constructive.
Right. What is the top sector, Ankit, you would bet on then? We have gone through a time-wise correction on the headline index. As you're saying, you're still constructive. You believe market is going through phases, but that's par for the course. Ultimately, earnings will be the driver. So if you are to tell me the top two sectors that you're bullish on, which one would it be?
Yeah, so if you look into, we are quite constructive on large private sector banks because there we are clearly seeing earnings, in fact, tracking relatively better than the expectation, and valuations are reasonable. In fact, it's trading at a bit of a discount or maybe average in the historical context. Second, we are quite constructive on the pharmaceutical side of it, which includes CRO and CDMO, contract manufacturing as a space. So no, and third might be, let's say, industrial, consumable as such. So these three pockets we will be quite constructive upon.
Ankit, on technology, I was reading some notes. Today Motilal Oswal came up with a note and they've turned bullish. But even in their bullish argument, they're saying that by FY28, which is when we see enterprise-wide AI adoption, the industry growth rates are only going to be 8 to 9%. So if the key driver for picking stocks now is going to be earnings, now tech companies are not going to give you double-digit earnings. Some mid-cap companies, of course, have been and will continue to do that. But on a broader scale, tech, even 3 years down the line, perhaps is going to give you high single-digit kind of return. So then where do you stand on tech? Or do you think the valuations make it compelling enough to look into the sector?
Yeah, no. So IT sector, yes, it has sort of underperformed, but for the right reason again, because given the AI is sort of a disruption, while clearly will be deflationary for the sector as such, and to that extent, growth profile any which way, given Indian IT services market share in global IT spending has already. Base growth profile as any which way sort of a coming off. And in that context, yes, currently sector growth is tracking maybe for large caps, maybe at around low single digit, which might improve to mid single digit going forward. And in that context, yes, 4-5% sort of a free cash flow yield do act as a floor. But having said that, until and unless the growth visibility improves to high single digit, it becomes very difficult to make a very significant overweight stance on the sector.
Ankit, thank you very much for joining in. Prashant, when I met NTT, the Japanese company, And they said that they're already seeing 50% productivity in the software development cycle on account of AI.
Increase.
Yes, a 50% productivity benefit or increase, not a cost reduction, a productivity increase on account of AI in the software, the entire software development, not just coding, but the entire segment. And they're saying in 2 years that number will be 70%. And that's quite, sizable in terms of, productivity benefits. And the question is this going to be deflationary?
No, this is per capita productivity. I mean,
per person.
So then basically you need lesser people.
I asked them, I said, does that mean that, you are involving fewer people in coding? And I think we'll play out that interview tomorrow. But again, I don't think any company is going to come out and say that, yeah, now we'll, hire 70% fewer people. But he says, no, there is work. So, we continue to hire and we need people. But there is productivity benefit and it's quantifiable.
You need people, but I think much lesser, right?
That's what I asked him. But but I was just surprised by the number. 50%, I think it's quite incredible.
Okay, well, let's move back to the markets and what's the futures and options positioning looking like? Nigel has walked across to the F&O desk. Nigel, take it away.
Well, if you look at the Nifty, in the last few minutes, it's suddenly taken a very, very sharp leg down. I think there's an expiry-related factor as well, gearing up for tomorrow's expiry. And there has been some lightening of positions, which is clearly evident from the morning itself, particularly in the broader markets. But this kind of a fall, it appears that it could be more linked to this expiry that will play out in the next 24 hours or so. Sharp downtick in the last few minutes. But as of now, things are still not very, very worrying because that 25,500 level is still holding out. The 20 DMA as well, which is ballpark around 25,800, that's still holding out. And the VIX is cooling off. Remember, it had a big surge in Friday's trading session. But the Nifty as well as the VIX, they normally have an indirect correlation. When the Nifty is down, the VIX moves up. This time around, that's not happened. So that's one reason why I'm not still very, very concerned. And the PCR, the last time I checked, it's moved down to around 0.8. Remember, just 2 sessions ago, it had gone to around 1.5. The PCR normally sees some kind of basing out at around 0.65 to around 0.7. So both those two indicators, a cooling off of the VIX, as well as the PCR holding at around 0.8 towards the lower end of the range, that will give the bull some kind of comfort, though the fall is a little bit worrying. And the reason that the PCR has come down because call writing, it's very, very aggressive from the word go itself. Even when the Nifty was in the green, you saw the premium on the calls getting eroded. 26,100, 26,150 call, 26,200 call. On all those 3 strikes, you're seeing massive amount of open interest built up and the premium getting eroded. Remember, there is a factor of a time value of money, part of the premium. And because the expiry is approaching, that's why that's getting eroded out there. Individual stocks, though, Wipro was one of the stocks that came in for a short covering bounce. That is a little bit higher, and the open interest is down. There are rolls as well that are taking place. There's a sense of some short covering even on Tech Mahindra. From the broader markets, few stocks are doing well, but NBCC, massive volumes out there, and there's a hint of cash market buying as well as short covering out there. While on Kalyan Jewellers, surge on open interest in the current contract itself, there is some shorts that's piling on the system. So the Nifty, at the low point of the day, the bulls will take heart from the fact that at least the VIX hasn't spiked up and the PCR is moving to the lower end of the range. But last few minutes has been a very, very sharp decline on the Nifty itself.
Yeah, that's a big downdraft that you're seeing in the markets now, down more than 100 points. Thank you, Nigel, for that update. Get into a break. We'll come back and get you a few BTST calls from our technical experts. Welcome back. As we've been pointing out, it looks like expiry-related jitters are dragging the markets down 100 points lower, and the Nifty is now closer to 25,950. Perfect time then to get in, Mitesh. Do you want to quickly update any trade on the basis of the fall that we're seeing right now, and then the stock-specific ideas?
Yeah, I think, at the beginning of the show, I said, we might be starting a pullback from the earlier highs, so which means that the market in the short term could trend lower. And I would like to add 2 STVT calls. So Manappuram is one of them. Keep a stop at about 277. Look for targets of around 270 or below. And IRIDA is another one which has come on the negative side. It's continuing its decline of the last 3-4 days. So sell or STVT here with a stop at 144.5 for targets of 139.
Okay, now STBT calls and cautious in the markets. Thank you, Mitesh, for joining in. Let's get you some important corporate bites. Now, amid growing fervor in the derivative space, here is an important voice from the commodities market. Praveena Rai, MD at MCX, tells that their goalpost is to reach 10 billion orders per day. She also shares her outlook for the company. Listen in.
What I heard is, you have to be ready for 10x, right? And I think that was really a rallying cry.
A ringing thing, huh?
Yeah, and I said, and I think all of us agreed within MCX that I think that really is our goalpost now. So I think we are going for 10x, and we sort of ballpark numbers looking at something like maybe 10 billion orders a day. So that's what we're getting prepared for now. And when we look at timelines and we say, look, we want to target to 10x, 10x may not be like a single short jump, right? So probably it's going to have 2 or 3 milestones. If I look at very headline numbers, and we've sort of quadrupled in the last 2 years. So if we say, hey, if I look at that as a potential run rate, and there could be best case, there can be like a better case, and so on and so forth. Looking at all of this, I would say we should look at a first benchmark in about 12 to 18 months as a milestone, and in 2 to 3 years, really be at the kind of levels we're talking about now.
Well, and the big story of the day, the government's new labour codes effective November 21st, 2025 bring gig as well as platform workers under formal social security for the first time. We'll understand the development and the impact. Vinny has been doing all the crunching of numbers, listening into managements as well. She joins us to give us a complete wrap. Hey, Vinny.
Hi, yes, so in terms of, obviously, first let's talk about the changes that will come in with this new code, right? There'll be a minimum wage that will come in for all workers, and there'll be a national floor wage as well that will be set by the central government. Gig and platform workers will be included under the social security. So that's the biggest change, that everyone is talking about as well. And obviously, there's going to be a basic pay that basic salary which you have in your CTC, that is going to be 50% of the total salary as an amount. So that is something that is interesting in terms of changes. Now, how does this actually benefit workers? One, fixed term employees as well as contract workers, they will receive similar benefits that a permanent employee would receive. The eligibility period for gratuity, which was 5 years, now will come down to 1 year. Overtime wages, obviously, that will be paid at double the normal rate. Appointment letters will be given and will be mandatory for all employees. So even if they are on just a short-term employee, they will still get those letters as well. It is more simplified in terms of compliances that will come through as well, and they'll get a lot of benefits that come in terms of PFs, in terms of other medicals. That also comes in for temporary employees as well. Now, what is the benefit coming in for the employer side, or what are the implications for the employers? One, it becomes simplified in terms of the matters that they have to handle. They expect to increase wages, will improve social security for the employees as well. That will help preserve them controlled in terms of trade union activities. So they'll have more control on that front as well. And in one more change that is an implication for employers would be fixed term employment options that provides a flexibility in hiring without long-term permanent commitments. Now, in terms of labor rules that is there for staffing companies, how does it benefit them? It increases the total addressable market, right? As of now, in staffing companies industry, there are around 65 lakh employees, while gig workers themselves alone account to around 1 crore employees. So that gets formalized. So formalization is something that will increase their market share. Other than that, in terms of 90% of the informal jobs will now come into formal sector. So this will lead to formalization, digitization, simplification, as well as improved productivity. Even for Swiggy and Eternal, yes, there is a somewhat of a short-term negative impact that one could see in, and analysts are also saying that companies, now will start providing health insurance to riders. And as of now, the change that has come in is that platforms must contribute 1 to 2% of the annual turnover for social security. So maybe because of this short-term impact, but long-term still a positive for these companies as well.
Thank you very much for that. Sudeep Bandyopadhyay is now joining in on the show. Sudeep, have you all done any analysis? Is there any company you would turn cautious on because of a potential increase in costs which they may not be able to pass through? For instance, you're seeing Urban Company down close to about 4%. You pull up that intraday chart of a Team Lease or Quest, and you can see a very sharp decline in the stock price from the day's high.
Well, I think you mentioned the 3 companies. I think I'm a little bit worried on Urban Company as far as the cost implication is concerned, because their model itself, envisages a huge army of, part-time or temporary or gig workers getting employed for getting the jobs done. So obviously, in the short term, their costs are going to go up, and how much of it they'll be able to pass on to the consumers is a little difficult to assess at this stage. But it will be challenging for them to pass on because it's a competitive market. But I will say one thing here is that certainty of these laws, rules, and codes is definitely a long-term positive for the entire industry. Today, there's a lot of gray areas, a lot of uncertainty, and a huge amount of confusion on account of most of these issues. So certain certainty will definitely augur well from a long-term stable business perspective. So even an urban company will know exactly what they're going to spend, and they will be able to handle things better in the long term. But yes, there will be a short-term implication. As far as team lease and other manpower consultants or manpower contractors, for lack of better word, I would say there would be an immediate impact. But long term, again, I don't think too much of a problem. Codification and simplification of the rules definitely will help the industry.
Do you want to make sense of Swiggy? That's up 5%, while Eternal is flattish. A little bit of a downtake. But why is Swiggy up? Is it just expiry factors or the fact that they're armed with such a large kitty after the fundraise, so they're better equipped to handle any cost increases?
Well, I think it's got to do with the expiry. I don't think it's got to do with either the labor code, because both of them are in the same boat. As far as fundraise is concerned, Eternal has enough in their kitty as well. So I don't think the Swiggy's fundraise will kind of create a negative impact on Eternal. So it's predominantly got to do with what's happening on the expiry side. So I don't think we should read anything beyond that. Between the two, we do like Eternal, and I think from an investment point of view, from a slightly longish term, Eternal does look good even at current valuations.
Okay, all right. Sudeep, just stay with us. Just one quick word. I think we should get, Siemens Energy up for you on the screen. Pull up the intraday chart. I think it was one of the stocks that were due for the MSCI rejig. I think, that suddenly moved to the low point of the day. Very, very volatile. It went down, I think, to around 3,080 odd. And then it saw a bit of a pullback. But quite a few stocks are bouncing around. Maybe we could get Vivek. He had that list of stocks that were likely to move around. I think Siemens was one of the stocks as well that were part of the list. But it was in the inclusions, actually as per what the Nuvuma note is. So that one is seeing some bit of volatility. Sometimes some of this play takes place a little in the run-up to the particular event, and the event is today. I'll tell you what, slip into a short break, come back, we'll continue our chat with Sudeep. We'll also get you an update on some of these stocks. Well, it's not stopping actually. The Nifty is down now 140 points. You'll have to attribute this to actually, the expiry-related factor. The HDFC Bank stock that was actually holding one end up, that's given all of that away. Remember, that was the one that in fact was, well in the green. That's taken a bit of a slippy slide down. Eternal is another stock that's taken a leg down, and Nestle India as well. These are all frontline names, and they have seen a lot of selling. And if to be fair, actually, from the broader markets, at the start of the show, there were around 750 stocks that were advancing from the stocks that were trading on the NSE. And currently as well, there are around 740 stocks on. So the breadth of the market has stayed as bad as it was at the start of the show. But let's focus on one of the gainers from the Nifty. Royal Enfield celebrated 125 years. The company's CEO took a ride with CNBC-TV18's Parikshit on the streets of Goa to take us through the experience of their motorcycles. Let's listen in to what the CEO had to say.
As of now, I do see the motorcycle industry will continue to grow in the near future. Currently, it is growing almost about some 7-8%. In fact, we have been growing. Even last quarter, we grew almost about 45% compared to last year. And in the whole H1 level, we grew almost about 27%. So our growth also has been good. And I do see the growth momentum will continue. But the powertrain may change. Technology disruptions are taking place. Consumer preferences are taking place. The preferences can be on the technology of the powertrain or the way the retail takes place. So as an organization, we are always proud to say we are a 125-year-old startup mentality company. And we are very agile. We enjoy that because fundamentally we feel, we have to continuously improve. the higher CC motorcycles, the era is slightly going off. I don't think people are really enjoying. If given a chance, even I won't enjoy that sort of a bigger motorcycles. And I want a motorcycle which has to be interacting with me. And I control the motorcycle and I enjoy the motorcycle. And that's why we said middleweight, Rashid, is what we will focus as a company. And the middleweight, our definition is 250cc to 750cc motorcycle. And currently we have 350cc, 450cc, 650cc platform. And I do believe strongly that even this market can grow because premiumization in India is the thing. And we are by far the motorcycles which is very accessible price point which we have brought in and gorgeous looking motorcycles and everybody is loving. And I do see there is a good growth even in this platform which we can bring in for future.
All right, well, that was the management of Royal Enfield in a very, very rare chat. But actually from the broader markets, we are saying that, things are looking jittery. Pull up the intraday chart of Prudent Corporate Advisory Services. Stock actually is flying away. Big uptick is what we're seeing on that particular name. Even I think, from the tech pack itself, I think a stock like Orient Pro suddenly moved to the high point of the day. So there are select stocks that are doing a thing of their own. Even RVNL, let's get that stock up for you on the screen. That stock, in fact, has suddenly seen a big spike up in the last few minutes. Big move is what we're seeing on RVNL as well. Let's get the intraday chart actually of that counter as well up for you on the screen. RVNL. Okay, yeah, that's that's the one. Sudeep, give us any stock. I'm throwing it open to you. We already had a chat on Royal Enfield. You want to comment on that, but I'm sure these sort of times give you good entry opportunity where you get the stock of your choice at the price of your choice. You want to name a few?
Well, I will go to a completely different segment, Nigel. I know you like the Royal Enfield product, but I won't go there. At this stage, I will look at PSU banks. I think there are significant opportunities sitting in PSU banks, particularly even the smaller PSU banks. So I do like Bank of Maharashtra quite a bit at current level. And this got nothing to do with the potential merger, consolidation, blah, blah. Just look at the valuation and compare it with maybe an equal-sized peer in the private sector, either in a banking space or an NBFC space. And, the answer is very glaring in front of us. And I'm just talking about one. I think you can pick up Central Bank of India. You can pick up many other smaller PSU banks, and they do look very, very good on comparison. For that matter, even if you look at SBI, State Bank of India, it's quoting about 1.1 book, whereas NBFCs like Bajaj and all are quoting at 5-6 time book. So I think there is a glaring gap, and somewhere this gap needs to be bridged, and it will be. I'm not saying they will become equal, but a significant bridging of the gap should and would happen.
Okay, all right. By the way, just one more stock, ACC, a big underperformer. All of a sudden, that stock has suddenly spiked up. Just pull the intraday chart out there. ACC is the one that's bursting away. A rank underperformer, actually, if I look at it from the cement basket, the market was not willing to give it valuations. Even after the 7% spike, if you take a look at the last 1 year chart, actually the stock is still down close to around 10%. So unsure what's going on there, but ACC is one of those names that have really bucked the trend today. But let's wind down the markets then. Last minute or so left. Stocks that did well today. Tech did very, very well. So the IT index was a relative outperformer. Motilal Oswal, they had come out with a note earlier today. They believe it's time to buy tech. So tech was one of the few indices that were in the green. And if you had a two-wheeler index, well, then that as well would be in the green. Because stocks like Royal Enfield as well as Bajaj Auto, both of them did pretty well, giving company to stocks like Tech Mahindra as well as Wipro on the upside. Losers, well, they came in from the metal pack as well as from the real estate pack. So you had JSW Steel, Tata Steel, both of them under pressure. And defense-related names as well were a little bit under the weather today. BEL was one of the top losers on the Nifty. And from the real estate basket, Prestige Estates did come in for some selling. CG Power did have an order cancellation. The street was jittery on that front. That stock, in fact, ended with a cut. And Sammaan Capital, management has been clarifying, but the street is still a little skeptical on their action on the erstwhile promoter. So that went home with a cut of around 4%. We talked about the Nifty doing well this month and outperforming, but the small cap index is still down close to around 4%, telling you there is pain in the broader market. So net, you could attribute some part of today's fall to actually expiry-related factor as well as MSCI rejig. But otherwise, there's been a sharp fall in today's trading session. Last tick closer to the low point of the day.
Disappointing mid-cap performance and the advanced decline ratio in particular. While the mid-cap index declined 0.5% in line with the frontline indices, look at the advanced decline ratio. Down at 1:3, and the gap between the two only widening. Some of the drags, notable ones include, Billion Brains Grow, that declined nearly 4.5%. Physics Wala also recent listing last week, stock under pressure. You had softness coming in a couple of these banks like a Yes Bank, IOC, PNB, IDFC First Bank. So some of these, mid-cap banks we can trade. On the way up, Federal Bank did well, so did Canara Bank, and Riddington was a big mover, stands out for the kind of volumes it did. All in all, disappointing session, perhaps the expiry at play. The Nifty ends below 25,950, a cut of 0.5%. Don't go anywhere. We're going to take a leave in closing bell, but on the other side, markets forward comes up next.